Welcome to the Tech Today podcast. It's your host, John Mayetta. We published an article today entitled Recessions Happen When Fed Funds Exceeds Personal Savings. Fed funds, of course, being the Fed funds rate, and personal savings being the personal savings rate. So I was playing with data last night. So I was looking at personal savings in relation to the Fed funds rate, in relation to unemployment rate, in relation to debt service costs as a percentage of disposable income. So I was looking at all those data inputs in relationship to each other in an effort to try to find a leading indicator of recession. Now, if you read us regularly, you know that I believe we've been in a recession for some time. I believe we dipped back in 2022. I believe we were on the precipice of an official recession in March of 2023 when the banks tightened before the Fed and FDIC stepped in with the Bank Term Funding Program. But I believe we've been in, frankly, a recession since 2022. Sometimes it's very mild. Sometimes it gets a bit more serious. And that's a function of, the government just simply not backing out the full impact of price inflation. CPI is understated, therefore the GDP deflator is understated, meaning when the government calculates real GDP, the number they back out from nominal GDP is artificially low. And I've explained in prior podcasts and in writings that a big reason why the government understates CPI is because so much of entitlement payments are benchmarked to CPI, So therefore, if the CPI rate is lower, what the federal government owes on the outbound for Social Security payments, as an example, that number is lower. The CPI, because the CPI kicker that's imputed into Social Security payments, that annual kicker is lower, if CPI is lower. And obviously it makes the sitting administration look good if particularly in a period of rapid price increases, if the CPI figure is a bit lower. So in any event, in playing around with Fed funds versus unemployment versus personal savings rates and debt payments and such, what I found is that if you look and plot the personal savings rate against Fed funds, it's a good predictor of recession. What specifically is a good predictor of recession? In periods where the Fed funds rate exceeds the personal savings rate, that is a good leading indicator of recession. Now, I only went back to 1970, and in doing so, you'll see that based on this chart here, let me blow this up for you. In periods where Fed funds, as marked by this red line, is greater than the personal savings rate, as marked by the green line, it's an accurate predictor of a looming recession. So what you're looking at is the Federal Reserve's St. Louis Fed data repository. And within Fred, whenever you create a calculation or run a query on a particular data set, it'll give you a time series return. And whenever you see a gray shaded bar, a gray vertical, that is considered to be an official recession, as the federal government declares recession. So, good predictor of recession in the late 70s, early 80s under Paul Volcker when he was Fed chair. 1990, leading into the Gulf War. That's when I was in college. You had a brief period where Fed funds exceeded personal savings rate. And what I will do in the show notes is I will link to the Excel data that's behind this chart. So you'll be able to see the specific months where Fed funds is greater than personal savings. Coming up in the 2000 periods in the late 90s, we had a period where Fed funds, that's back when I was a high yield guy. And I remember Fed funds was consistently in a shade above 6%, 6 to 6.5%. And it exceeded the personal savings rate. That was at a time when we had the dot-com boom and tech stocks went to the moon. Frankly, anything that put .com at the end of their name and or in the URL, but particularly in their name, went off to the moon, much like companies today that are, leveraging AI in their positioning. Even if they've been using some simple machine learning algorithms for the past 15 years, now if they highlight AI in their earnings call and their press releases, the stock gets a lift. So that's a story for another day, but the equity market today is as overvalued as it has been at any time in history. The next recession, of course, was the home boom, when you had banks giving people who had no business buying a home credit extensions to purchase a home. So that was the residential home boom. And of course, that went south. And of course, we had the big bank bailouts as that residential contagion spread. We had the bank bailouts of 08 and 09 under Hank Paulson, Tim Geithner, Ben Bernanke. Shortly thereafter started the period of QE and artificially low interest rates. So you had Fed funds, basically at zero for the better part of the next decade. And so that was the story from 2010 until 2020, when, of course, personal savings far outpaced the Fed funds rate as the Trump administration and the Biden administration each contributed to massive fiscal stimulus. Each administration contributing to the inflation problem we have today. I believe the Biden White House made a big strategic error. They should have tightened policy, and they could have used Trump's massive deficit spending under the guise of COVID relief. They could have used Trump's massive deficit spending as a reason to tighten aggressively, to tighten quickly after stepping into the Oval Office in 2021. To tighten fiscal spending, of course, and put the U.S. back on a path of, well, getting to fiscal break even. I'll settle for fiscal break even. I don't expect to see surpluses again in my lifetime. But instead, the Biden administration stepped on the accelerator, threw good money after bad, ran their own series of multi-trillion-dollar deficits, inflated the money supply, and caused massive price increases. Such that the American public finds it difficult to absorb the price increases that have hit them day to day. I mean, I've talked about the price of food a number of times on the podcast, and if you look at the CPI data, it implies that food prices have gone up kind of 10%-ish year over year, each year for the past several years. When that doesn't, that number is laughable. So things like food expenses have pushed some people over to the edge to where now they're paying for day-to-day expenses with credit cards. So credit card debt has accelerated at a pace that we haven't seen before. And savings have been massively depleted. I think they're below 3%. I think the last reading we have is like 3.2%, but I would guess it's below 3% at this juncture, the personal savings rate here in our final circle, where guess what? The Fed funds rate has once again exceeded the personal savings rate, which would suggest that recession is around the corner. There isn't a hard predictor around how many months or quarters you would need to see Fed funds in excess of personal savings before you hit with a recession. But I just think it's fascinating that personal savings have been depleted that quickly. So you had, two series of stimulus checks, one under Trump, one under Biden. You had the employee retention credit, which was a boon to small, mid-sized businesses with 500 employees or less. And company ownership got $26,000, a one-time payment of $26,000 per employee. So that was a huge boon to small business. I think that was the program that allowed a lot of small and medium-sized business owners to, buy multi-million-dollar homes, take a number of international vacations, expensive cars. So big ticket items. Right, that was the question last year after the banks tightened so rapidly in the March quarter, and the Fed had to step in. And it very much looked like if the Fed did not step in, we were in recession. Where did the consumer strength come from? And it came from these fiscal spending programs like the employee retention credit. And that program ended at the end of September of 2023. So those stimulus programs have bled dry. We have elevated Fed funds. And it's just a question of time before the consumer so completely rolls over that even the Biden administration, in its effort to manipulate the reported numbers, particularly the unemployment rate, which is the bogus job numbers that come out, that are always revised downward. I mean, this administration has zero credibility on the economic front. So it's just a question of time before we are in a recession that even the Biden administration will not be able to deny. That's all for now. See you next time.